talk about bonds. So far, we talked about the concept of time value of money, different types of cash flows, how to get the present value and future value of those cash flows, and so on. So, starting in topic 5, we're gonna use that math and those finance concepts to calculate the values of various securities. Okay. First, we're gonna do bonds. Okay, topic 5, bonds. So, going back to the cycle of money slide, I don't want you to forget the big picture. Okay, so we're still talking about corporate finance, and I showed you this slide in exam 1. So it shows you how corporations raise capital from investors, and how what kind of cash flows go back to investors. The cycle of money. Okay, so the first method that corporations use to raise money is by issuing bonds. Okay, bonds. So we'll talk about bonds today. Yeah. So as I said before, whenever corporations issue bonds, that means they're borrowing money from investors. Corporations borrow money from investors. And whoever provides that money, they're called bondholders. Okay, these are investors. And in return, they expect to get some kind of cash flow. Okay, so they expect a return on their investment, and these cash flows consist of coupon payments plus the par value at the end, which we'll talk about soon. Okay, so we're focusing on this part of the cycle of money, and the next chapter is on stocks. Okay, yeah, so bonds are issued by borrowers. Okay, so here we're going to talk about corporate bonds because we're doing corporate finance, but governments borrow money too. Okay, for example, the U.S. government borrows money heavily. There are U.S. government bonds. So depending on the duration of the bond, that is the maturity of the bond, sometimes they're called treasury bills, treasury notes, or treasury bonds. Okay, so treasury bills are short term, with the maturities. Basically, the borrowing period ends within 1 year. Okay, we'll talk about maturities. Maturity less than 1 year. Notes are usually from 1 year to, I think, 10 years. Bonds are bonds where the maturity is over 10 years. Okay. So yeah, corporations, governments, they all borrow money from investors, and they use the money to run the corporation or run the government. Okay. Let's see. Okay. And yeah. So whether I'll just do this. Issuer is the entity that's borrowing money. They're the borrowers. Okay. They issue bonds, and investors provide money. So they might, for example, investors might give, we'll do corporation. Investors might give the corporation $1,000 now by purchasing the corporate bond, and in return, the corporation will promise the investors like maybe $10, or I'll just say $50 every year for the next 10 years, plus the principal back in 10 years. Okay, so that's basically the format. Okay, So bondholders will provide the corporation $1,000 right now, and in return, the corporation is gonna pay the investors back, the bondholders back, the coupon payments plus the par value at the end. Okay, I'll show you the timeline that's right here. Okay, yeah. So investors lend money to the borrowers or the issuers, and in return, again, they're getting periodic interest payments. So this is the periodic interest payment, $50 every year for the next 10 years. That's the coupon payments shown here. Okay, coupon payments and the principal amount at maturity. It's called the par value or the face value right here. Okay, yeah, let me clean it up. Yeah, so yeah, investors expect coupon payments plus the par value or the face value at the end. And since we talked about the math, I hope that you can immediately see what type of cash flow pattern we're dealing with. This deal, it's a deal, right? Comes with two things, two components. Okay, so this is more like a combination problem that we talked about in topic 3, where the first component is, oops, yeah, this is fine. Actually, first component is the annuity component. It's a regular annuity, right? The coupon payments are in the form of a regular annuity. Okay, I hope you know. And the par value is a separate component. The $1,000. This is a one-time lump sum cash flow that occurs in year N. Okay. And the first thing that we'll do in this topic is we'll get the present value of this bond to calculate the fair value of the bond. Okay, bond pricing. So yeah, I'll give you the formula for bond pricing, but you should immediately see that we're just gonna combine the PVA formula, since this is a regular annuity, plus the topic 2 formula, PV formula, one that looks like this. Since this is a one-time cash flow, topic 2 example right here. Okay, so this plus this will give you the present value of a bond. Okay, so some terminology. Okay, so whenever investors purchase these corporate bonds, where is it? Yeah, investors purchase corporate bonds, they'll get this thing called a bond certificate. Okay, where's the bond certificate? I think these days there's no actual certificate because everything's done electronically, but this is what it used to look like apparently back in 2008. Okay, so this certificate contains all the relevant information for the bondholders. Okay, the details of the deal. Okay, so I'll just say the details of the deal. I'll just call it the deal. Okay, here's what you get if you give us this money. So the price is the bond price. Okay, meaning how much you have to give the company right now. Okay, amount you have to pay today for the bond. The par value or the face value is the principal amount that the issuer repays at the bond's maturity. Okay, so the issuer is the corporation here, right? So when the bond matures, when the bond's duration is done, the company will pay the bondholder the final payment. So in this course, we'll always assume a par value of $1,000. Okay, and we have the maturity date. Yeah, I keep saying maturity, and this is what it is. Maturity is the end of the loan. Okay, It's the point at which the issuer pays the final interest payment and repays the principal amount. Okay, if we go back to the previous slide, you'll see that maturity is right here. At this point, the loan basically ends. Okay, and at which point the bondholder, investor, will receive the final coupon payment and the par value, and then the contract is done. Okay, that's the maturity date. The coupon rate is the rate of interest paid by the issuer. Okay, so basically the coupon rate tells you how much you get in coupon payments. Is it like $50 or $100 every period? Okay, coupon rate. So yeah, we're seeing all of the components here. We have the price, we have the, maybe we don't have the par value, but maturity date, we have the coupon rate, and so on. Okay, the coupon payment, the actual dollar amount, is how much interest payment you will actually get from the corporation. Okay, and it can be calculated as the coupon rate times the par value, which is $1,000, divided by number of payments per year. Okay, so this is new, right? So bondholders, we're going to deal with annual coupon bonds and semi-annual coupon bonds. Okay, and as the name suggests, for annual bonds, you get paid once. For semi-annual coupon bonds, you get paid twice. So this number of payments per year is either 1 or 2. And that's also the same thing as the M. It's the frequency of coupon payments and compounding. Okay, so you don't need to worry about this part. Just know that for annual coupon bonds, M is always 1. For semi-annual coupon bonds, M is 2. Okay, and this is used to calculate the number of payments per year, and so on. You'll see. Lastly, we have the yield to maturity. This is also new. It's the discount rate. So this is related to the R that's used in the calculations. Okay, so if you recall, in the previous chapters, I gave you the R, right? I told you that the rate of return is like 7%, or the interest rate is 7%, or whatever, discount rate, right? So the yield to maturity is the R, or related to the R, that'll be used in bond pricing. Okay, so what the yield to maturity represents is also important, and I'll just use a different color. Yield to maturity represents the expected rate of return if the bond is held until maturity. Okay, that is, in the previous example, let's say the bond price is $1,000 and the coupon payments are $50. Okay, the par is also 1,000. So if an investor purchases this bond for $1,000 right now and receives these payments, their annual rate of return, if the bond is held until maturity, if they collect all of the payments, that is the YTM, yield to maturity. Okay, so that's the expected rate of return if someone buys this bond for $1,000 and they plan to hold it until maturity, collecting all of the payments. That's the yield to maturity. Okay, so that's a lot of new terminology, but let me just show you a real life example. Okay, so I just said governments and corporations, they all issue bonds. Okay, so here's a company, we have Apple right here, right? Apple. Okay, Apple is also a corporation that needs capital. Okay, so they also issue bonds. Here, let me click on bond information. So it shows you a lot of the information that we just talked about. The bond issuer, let me see, issuer is Apple Inc. Okay, and the announcement date down here was 2014. The issue date, the bond was issued in 2014, and the maturity date was 2044. So we can see that it was a 30-year bond that was issued. Okay, so since it's 2026 right now, the years to maturity, the bond has 17 years left until maturity. It's been about 12.2 years. The bond was a 30-year bond, so it has about 18 years remaining until maturity. Okay, we have the annual coupon rate down here. Let me see. Coupon rate, annual coupon rate is 4.45%. Okay, so based on this, the coupon amount is determined. Okay, coupon frequency, this is the M that we talked about in our slide just right now. It's a semi-annual coupon bond, so the M would be 2. Okay, so bondholders of this bond will get paid twice per year, every 6 months. Okay, let's see. Bond type, obviously, it's a corporate bond. Apple's a corporation, and that's about it. Okay, yeah. So, yeah. We'll come back to this graph later. Okay, I just want to show you that you can see that the bond price, the price of this bond, so let's do since inception. Okay, when it was first issued, it was about $994, assuming a par value of $1,000. Okay, but as you can see, the price of the bond fluctuated quite a bit over the years, right? Sometimes it went up to like 140. It dropped down to, what is it right now? Like 80s. Right now it's selling at $90 approximately, $900. Okay, so we'll talk about why this is. Okay, but just know for now that corporations like Apple issue bonds, and the information that we just talked about, the details of the deal were shown like here. Okay, yeah. So just more background information. So as I mentioned, corporations borrow money and governments borrow money too. Okay, and here's always this is a question I always ask on the exam. So in general, I'll just say in general, I usually ask this in question, but I ask this in class in person. In general, it's true that government bonds are safer than corporate bonds. Okay, so when I say safe, it means the probability that the borrower can fulfill their financial obligation is higher. Okay, the probability that the borrower fulfills its obligation meaning when they borrowed money, they have to pay back the investors, the coupon payments and the par value on time. Okay, is high. So from the investor's perspective, a safer bond is one where the probability of repayment is pretty certain. Okay, so going back to the statement, in general, government bonds are safer than corporate bonds. Okay, so hopefully you agree. Okay? Just for fun. Okay, so let's say this is a country. Okay, country A. Okay, within that country, so we have these multinational corporations these days, but let's just assume that companies are operating within a country, just for fun. Okay, and there are a bunch of companies in the in country A. Company 1, Company 2, Company 3, Company 4. So generally, it's true that governments are more financially stable, basically, financially stable, that government bonds are safer than the corporate bonds within that country, usually, right? But that's not always the case, okay? So on the exam, as you saw in exam 1, I'll ask a bunch of true or false questions as the conceptual question. Let me give you this statement. Which of the following is true? And I'll have a statement on bonds. One of them could be all government bonds are safer than corporate bonds. What do you think? Okay. Yeah. Usually I get a bunch of answers, and usually if people get this right, this is this is not a true statement. Okay, I'll say this is false, because if you think about it, usually it's true. But if we were to compare, we just looked at Apple. Let's say for a corporate bond, we're talking about Apple. And if we're talking about the U.S. government, it's usually true that it's safer. But if we talk about countries like Iran right now, they're not doing well, right? So are they safer than Apple in terms of the probability of repayment? I wouldn't think so, right? And not just Iran, but many other countries are less financially stable than companies like Apple, right? So this statement would be false. So on the exam, read the question carefully, and you just gotta pay attention to the details. You can't just, you gotta read the question carefully. Okay, all government bonds are safer is not true. Okay, and that's usually on the exam. Okay, yeah, and so bond types depend on the issuer, who's borrowing money, corporations or governments. Also, it depends on the coupon schemes. Okay, so we talked about the annual coupon bonds, which pay coupons once per year. We talked about the semi-annual coupon bonds that pay coupons twice per year. So just two different types. There's also something called a zero coupon bond. So it's a bond that does not pay coupon payments. An example is the treasury bills. So treasury bills, T-bills, basically U.S. government borrows for 1 year, less than 1 year. 1 year, okay? So if you were to draw the timeline for this type of a bond, the zero coupon bond, it looks like this. We're doing the zero coupon bond. Timeline looks like this. So as an investor, your timeline, maybe it's a 6-month treasury bill. If you give the U.S. government $1,000, it'll pay you back. Say these days, I'm not really sure, but maybe like $35. Okay, so I think right now the yield on the U.S. Treasury bonds are like 5%, 4%, 5%, 4.5. So 6 months, maybe like 3.5. Okay. But anyway, yeah, this is the cash flow or the timeline for a treasury bill. Note that it doesn't have any coupon payments in the middle. Okay, no coupon payments, right? 0, 0, 0, 0. So the deal is you just get a lump sum amount at maturity. So this is like a topic 2 problem. So if this didn't exist and I asked you for the present value of this deal, you just apply the topic 2 formula, which is this, right? If I gave you an R, you can calculate the present value, okay? Okay. Good. Okay. Hold on. Okay, before we do the pricing, let me just tell you a little more about bonds and then we'll continue. Okay. So the markets can be classified into based on many different characteristics, but we'll make a distinction here between a primary market and the secondary market. Okay. So the setting here is, as you know, corporations needed money. Okay, so they issued bonds, and investors purchased these bonds. Okay, so investors are providing capital to corporations. In return, corporations will pay them back the coupons and par, the details, 10 years maybe, and so on. Okay, that's the deal. Okay, so in the primary market, that's where corporations issue new bonds to investors. Okay, so in the primary market, corporations issue new bonds to investors. Okay, so these investors are usually institutional investors. These those mutual funds, hedge funds, banks, pension funds, ETFs, and so on. Not many retail investors. No, I wouldn't say none, but a very small percentage of individual investors. Okay, so institutions participate in this primary market, and at this point, basically the corporation is happy. They got what they wanted. They needed money, and they got this money. Okay, so I'm telling you this because I just showed you that Apple's bond price fluctuated over time, right? So this bond price fluctuation is happening in the secondary market. Okay, so that's this right here. So after the bond is issued, new bonds are sold to investors, and corporation got the $1,000, and they're just basically done. They got what they wanted. Now their job is to pay back the investor. Whoever holds the bond certificate or the ownership, they have to fulfill this obligation. Okay, so at this point, corporation doesn't care who holds the bond certificate. Okay, the trading of the bond happens in the secondary market, where maybe the initial bondholder sell the bond to other investors. Okay, maybe they sell it to other institutional investors, or maybe retail investors buy them. Doesn't matter. But after this deal is done, now the trading of the bond happens. Trading of the bond happens in the secondary market. Okay, and the price fluctuation of the bonds here, the corporation doesn't really care about. Again, they got the funding they needed, and their job now is to pay back the investors what they promised. But who holds them, it doesn't really matter to them. They just gotta pay them back. Okay, So yeah, and that's where this price fluctuation occurs. Okay. Okay. Yeah, we'll do the pricing in the next video.